Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tigre. Our victim of the day is Kyle Floyd. He's the CEO of VOX Royalty. It's a new or renewed royalty play on the precious metals market. It's been growing, and a lot of my readers and audience have asked about it, so I took the chance to say yes when they asked if they could do an interview. So Kyle, why don't you go ahead and give us the elevator speech, and then I've got a lot of questions for you.
Sure, thanks, Lobo. Well, for those that don't know VOX Royalty Corp, we are a company that specifically focuses on buying third-party royalties. And we've built a portfolio of 55 royalties and streams all around the world. It is precious focused. I believe we have one of the most exciting portfolios in terms of development stage assets coming into production. We went public in just May of last year. We're about $120 million market cap. At that point that we went public, we had one production stage asset. We now have 5. We expect to end 2023 with approximately 10 and 17 that we believe have visibility towards being in production over the relative medium term. So very excited about our portfolio. We think it provides a lot of leverage for investors in the right ways. And that is the quick high level overview on VOX Royalty Corp.
Okay, well, thank you for being so pithy. Let's focus in and make sure we have our definitions here. I notice in your PowerPoint it says that you're 70% precious. Is that by number of royalties or is that by cash flow? What does that 70% mean?
Sure. So 70% is the NAV weighting in our portfolio. And so when you look at NAV weighting, that's present value of basically future expected cash flows. And so that's 70% as it stands now. Cash flows are actually increasing from precious. Right now, it probably sits at about in the neighborhood of about 40 to 50% precious cash flows for what will be this year. Next year, that flips to 80 as we have a very significant amount of our revenue coming from gold assets that are newly online for us. So that gives you kind of a flavor of what's feeding our cash flow.
Okay, very good. And does precious include platinum group metals as well? And there's diamonds in your portfolio. Those things are kind of precious, but when I think of precious metals, I mostly think of gold and silver. So how do you define precious?
Yeah, so precious, we would, some of our precious deposits, if you look at Pedra Branca, the largest developing platinum group metals project in all of South America, that feeds into that, but that's PGM plus gold. So they kind of run together in a lot of instances. So we do lump those together. So I would say platinum groups metals, diamonds a smaller part of our cash flow, but I would put that into the precious category. But generally speaking, if you look at cash flow next year and how that kind of continues to project out, about 80% of that will be from gold.
Okay. I really appreciate the way you're answering these questions very directly. I mean, there's often this big roundabout story, but I like that. Okay, so let me dial in on one point here. I remember when you first started out, you had these production assets, but some of them, like the Dry Creek there in Australia. It's part of a producing mine, but at least at the time, Dry Creek wasn't in production. So I'm wondering, of these 5 producing royalties, how many are actually in production right now and cash flowing to VOX?
Yeah, good question, Lobo. So right now we have 5 projects that we have royalties over producing. The only one that is not yet producing cash flow to us in that group is the Segalola asset operated by Thor Explorations, and that's because it had to go through commercial production. And then at that point, that commercial production is hit, where we expect that will be essentially royalty revenue earned to us at some point in this fourth quarter. So they've just announced commercial production. So that was the milestone that then triggers cash flow to VOX.
Right. So up until then, it was the ramp up, pre-commercial production. It was negative expense rather than revenue and all that stuff. So your royalty didn't kick in. Okay. On a similar tone, I was wondering that it says on your presentation you have 35 million ounces gold equivalent associated resource on VOX royalty assets. Do you have a royalty on all 35 million of those ounces, or do you have a royalty on pieces of mines, the larger group of which adds up to 35 million ounces?
Yeah, absolutely. I can shed some more light on that. So what we have is we have a royalty that, and some of it is our estimation. So this is taking into account projects that we don't have a royalty that covers the entire project. this is what we believe our royalty covers as, in some cases, not 100% of an overall resource. So that 35 million takes into account that some projects we don't have a royalty that covers the entirety of that resource or of that reserve.
Okay, so for example, Dry Creek is only part of a larger project. That 35 million only includes the Dry Creek portion of the larger mine.
Correct. So that's 3 deposits that are, one's in production now, 2 are scheduled to come into production at some stage over the near term. But that's 3 open pits. It just counts those 3 open pits. It doesn't count all of what feeds the Higginsville operations. Beta Hunt, I believe, feeds Higginsville. There's a lot that feeds that Higginsville mill. That just encapsulates our projects that have royalties over them.
Okay, so you've got 10 by the end of 2023, you say. How certain is that? Are all of these being built and we have a expected first pour within that time frame, or is it feasibility level and we're hoping that maybe they'll be there? Can you help us quantify that growth profile?
Yeah, I think it's a really exciting growth profile, and it's a great question. The reality is we're just basing that off of operator guidance. So that is purely based on what operators are either telling the market or telling us directly. In certain cases, there's a private operator in there that we've had discussions with, and relying on those discussions. But those are based on operator guidance. Most of them are public. There's only one instance, Mount Ida, that's a private operator that just announced an EPC contract for 72 million. And they've guided us to being in production in 2023. So that is based on operator guidance. That's not our subjective kind of viewpoint or analysis. That is operator guidance. As you look at that kind of bucket that takes us to 17 producing assets, that's a combination of operator guidance and construction decisions that are impending. So someone like Alamos and the Lynn Lake deposit, or the McClellan deposit that we have that feeds Lynn Lake. Those types of situations, operators are giving guidance towards construction decisions, and we're also making some inferences in some of those situations. But I think we're being overall very, very conservative in terms of our forward-looking expectations on producing assets.
Okay, very good. So sort of queuing off of that, I had some questions about the definition of development assets looking over the portfolio. And I looked at, Bowden's, for example. They're still exploring. They're finding that deeper silver. It's exciting, but they're not building a mine. It doesn't seem like they really have even defined the mine they want to build yet. Is it fair to call an asset like that a development stage asset?
Look, I think so. They are advancing a feasibility study. I believe they've come out already with a PEA, preliminary economic assessment. They have engineering work done. They have come out with rough economics for the project. So I think we actually take a much tighter criteria than most royalty companies in terms of what we would qualify a development stage asset. Development stage for us is a project that's either been in production or has engineering around it. So that project fits, that it has engineering done around it, has economics done around it, or completed around it. So, and they're in final permitting. So I think, that absolutely qualifies as a development stage asset. And I would tell you, if you looked at most of our peers, what they will qualify as development stage is typically anything that has a resource or above. So we've taken actually, I think, a tighter criteria than most.
Yeah, I think of development as mine building or gearing up for mine building. So a PEA would not fall in that bucket in my book, but I hear you. Let me push back a little bit more on this subject.
And Lobo, the only remark I'd make back to that is you have plenty of assets, and I'm not saying it's the right way to do it. We've had plenty of assets go into production on PEAs. I can point to some successful ones like Silvercrest and others, but look, I'll agree with you on that I think, feasibility and beyond is what's needed to bring a project of material weight into production. But these do have engineering studies. They're at a stage that we would say, look, the distinction you're making is construction versus ongoing development. And
I would go so far as pre-construction. Like you know what the mine is, right? You're already, even before the construction decision is there, you're ordering long lead time items. You're starting your civil engineering. Like you can tell this is a development start. Like they're going to build this mine, or they're going to take it over, and somebody's going to build this mine. It's happening, right? You can see it. Whereas the PEA level, it's kind of like there's the lake. We think there's a fish in it.
Bowden is a great example. It's in final permitting. It has, it might even be at pre-fees stage. So, you can fact check me on that and let me know, but I believe it's at pre-fees. Anyway, they're advancing. That's a very real project that's at this stage of final permitting with what they're doing. Look, there's different ways you can classify development. I think we've actually taken a tighter screen to that than most in our industry. But look, I think we've tried to be pretty clear about what we qualify.
I'm aware that I'm a curmudgeon and I have tighter criteria, but there's a reason for that, and one of them is that I've been burned, right? Oh yeah, we're going to build a mine, it's going to be great, and then either they don't, or they do and it's not great. And one of the things that has burned me the most has been mine building on a PEA or no study. Oh, it's right there, we can just backhoe this thing and put it through the plant. And an example of that was Banks Island Gold that had the Yellow Giant mine, which is now something you have a royalty on, and it's classified as care and maintenance development. But that thing was shut down. They had a tiny little spill. I was there at the time. I mean, it was like a pickup truck load of totally inert rock. It was just quartz sitting there. It was not dangerous, not a bad deal. I get it. I'm not up in arms about this giant toxic spill. I understand that never happened. But it burned bridges with the First Nations, and I've also talked to the regulator since then. It wasn't just that little spill from a rain overflow. There were things that, let's just say, were not done right, that the mine was not in compliance as thought. And so you've got the regulators and you've got the First Nations. I mean, that's a really tough row to hoe. And is it fair to call something like that until everything is sorted out? Can something like that really be thought of as a growth asset or a development asset?
Look, I hear you on all those points, and that's a sad story of what can go wrong in the mining sector, for sure. It was actually, while it was in production, it was actually cash flow positive. That was it, I think, at $1,400 gold. So the problem there was, I think it was a leaky operation overall. There's no perfect mining operation out there, by the way. And so if you're, I think Warren Buffett says, if you tail someone long enough, you'll find that they've made an infraction somewhere. I think that is the case in that situation to a degree. I think it was a little sloppy. The reality is we carry that on our books at zero value. Is it a royalty that I think eventually can be back in production? It was in production. It had a PEA done on it, a revised PEA, I think as late as 2017. So, and I know that MCC, who owns that project, is trying to advance it. So look, again, I think we're pretty clear about what's development stage. That's not in that bucket of near-term producing assets. That is in frankly, we mention it as an asset, but it's not something that I think adds material value to investors at this point. And it's not something that we're forecasting being in production anytime soon.
Right. Well, if you carry it on your books at zero value, I think that's a fair enough answer. I mean, I can't ask you to, I suppose I could ask you to make it a negative value, but then you wouldn't have it on the books. So I get that. But sort of the point relating to the larger portfolio question is, I remember very specifically, because I was involved in that story from before the time they built the mine, and they built it on a PEA because it was so simple. The quartz was right there, right near the surface, high grade. And then they had problems with, bad ground, so the head grade wasn't what they thought. But the real killer earlier on was that there was a garnet contamination that had the same specific gravity as the pyrite that had the gold. And so, that's the sort of thing that the PEA level metallurgy didn't catch, but full feasibility would have caught, I think. And they just didn't know, and they were that close to success. I understand it was high grade, and they actually started becoming cash flow positive. But that experience really made an impression on me. It was specifically this thing, like, who would have known that these particular unimportant, it's not even bad metallurgy, right? It's not like garnet is somehow refractory or something like that. It just so happened that in this case it had the same specific gravity, and it totally buggered their recoveries. So that makes me nervous when people talk about PEA type assets as development assets.
You find no argument with me. However, it is an asset that at that stage of PEA, we would call it in the development category. Again, it's really how you would classify. And if you look at it, say we're going from 5 to 10 production assets over the next, let's call it 2 years. And I think there's upside on that number. though we're trying to say what's production stage, and I think if you look at our website and our presentation, we're trying to delineate what beyond what's development stage and what's not development stage. What do we actually think? And a lot of that's based on, I think, pretty conservative analysis and operator guidance. What actually is coming into production? I agree with you. I think there's a lot of horror stories of projects put in production on the back of a PA. So I make no bones about it. I agree with you that feasibility is important, and I think there's a lot of backup for that position. In the case of Banks Island, that's just a story of an unfortunate situation. And again, there's going to be assets that work and assets that don't work. And I think, to be honest, a royalty portfolio insulates you from a lot of that pain when assets don't work.
Well, yeah, if you've got 55 royalties and this is one of them, all right, fair enough. Let's not beat that to death. I had to ask. And maybe the next way to go from this question is, you're the CEO, but you have a chief investment officer, Spencer Cole. And so he's the guy who actually picks the royalties you're going to buy or does your due diligence. He's a mining engineer. I've never met him. I've never heard of him. Who is this guy? And, how do we know he's any good at picking great royalties?
Well, we have a fantastic team, and it's not just myself, and it's not just Spencer Cole. It's also Rian Easter, who's really a renowned geologist. He's in Perth, Australia for us. He's worked all the majors from BHP to Randgold, and led a lot of their greenfields exploration campaigns. And then there's Simon Cooper, who's been with us for a while now. He is both a mining engineer and geologist. He's worked at some of those interesting projects around the world, from Asia to Africa, Glencore's operations in the Congo to Australia. So we have a very, very deep team of technical experts. And I think it's really important when anyone's looking at investing in a royalty company, do they actually have the people on the front lines of their business, not paying third-party consultants, because they'll tell you generally what you want to hear. Do you actually have people on the front lines of your business that can understand asset quality and then obviously also understand the royalty that overlays that? So Spencer Cole is our chief investment officer. Him and Rian Easter, were brought into the business as part of our acquisition of Mineral Royalties Online, which is that proprietary database of what is now 8,000 proprietary royalties that we purchased for $2.1 million back in 2019. But we have a full team that looks first and foremost at the technical elements of these projects. Our team has been involved in over $1 billion of royalty transactions. Most of us have been eating, living, and breathing this space for over a decade now. And so I think we have one of the deepest teams in terms of understanding, and we've done the work as well. We've studied what's worked for Franco and Royal and others and applied that to our business, and been able to shape and mold a business with competitive advantages focused on risk-adjusted returns in the royalty sector. But Spencer Cole is a big part of that for us, indeed.
All righty. And it's funny, you'd think, an engineer is going to be a nuts and bolts kind of guy, very facts-oriented, but I have seen engineers just sort of fall in love with their favorite mines, or this historic past production, and it's so cool, and they just seem to forget the purpose is to make money, not how cool it was what the old timers achieved here and so on. I'm not throwing all engineers under the bus, but I got to
I usually hear most people going the other way with that and accusing the geologists of that mindset. But look, it can happen to anyone when you're scrutinizing assets.
Understood. All right. Well, I'd look forward to hopefully meeting Spencer and the team at some point in the future. All right. So further in the corporate direction, talking about your stock, it's interesting. You IPO'd last year, May, and as I pulled up the chart this morning, it looks like you're almost exactly the same share price where you were at that time. So you went from a handful of assets, and including graphite and diamonds, and now you have much more of a precious promise fulfilled there, a lot more assets, but the share price hasn't gone anywhere. So, you're working hard, but is it doing any good for shareholders? Or what's the plan to change that?
Yeah, look, I would say we've done a lot of things really well fundamentally. We've picked really good assets at really good value. We were private. Look, Banks Island, that was a legacy deal we started working on in 2013. We learned a lot from deals like that in 2013, 2014, and then really oriented our business around this acquisition of exclusively third-party royalties, where we weren't reliant on mining companies looking for capital. We were able to go out, scan the world for interesting developments over interesting assets. We're really event-driven, looking for assets that we believe have a lot more value than maybe what the market expects, or what is projected outward from that project at maybe a layman type of perspective. So we're looking for interesting developments on assets all around the world, and we've built a business model around finding those royalty opportunities. And so we've done a very good job continuing to build on that model and on that basis, finding good value and really exciting royalties, I think better than anybody else in the marketplace today, which obviously should be the goal. In terms of what's happened with the stock price, so we've added a tremendous amount of producing assets. We bought them. We typically buy them anywhere from 3 months to 24 months out from production, where we find the deepest value, and then let those naturally re-rate in our portfolio. That's happening at a pace I don't think has ever been seen in a royalty company. Now, the fundamentals from a stock price perspective, I don't think have been perfectly correlated with the fundamentals of the business. And I take on some responsibility for that. We were private for 7 years. We're not a new royalty company. And we did not have the investor awareness apparatus built when we went public. And so a lot of the royalties that we acquired early on were in stock and convertible notes. The royalty sellers, remember, they're not the operators. This is not a core asset for them. What we did is we essentially swapped out one non-core asset, which was the royalty, which is one of the reasons why we got that at really good value, for what they viewed as a slightly more liquid asset, which was our stock. And so our stock was sold pretty much as soon as the restrictions were lifted, continuously over that period of time. So that's one of the reasons why our stock has been very much held down. We've worked through that. We've tightened our business model. We're now not issuing stock, and if we do, it's got very long lockup periods. So we're changing those supply demand fundamentals. We're increasing the awareness around Vox Royalty Corp. You've got to have some investor awareness program under you, and we need to do a better job there. And I think we fixed that, and that's reflected in the stock price. I think we're still great value for where we trade today. The fundamentals are there. I think we have a very real chance of re-rating into where some of our peers trade, which is a much higher relative multiple. We have the business and the fundamentals that support that, but acknowledge that we needed improvement in some categories as a publicly traded company, and I think we've made those improvements. Okay,
I hear you on that. Let me just looking over the when you first came out, there was no revenue. It was kind of weird. You have 5 producing assets, but there was no revenue. It's just really strange. And I see that things have turned around, and I was very happy to see, oh, hey, Q2 net income. And then I looked at it, and the net income was twice the gross profit. So how did that happen? And are you actually cash flow positive? I'm sure there are non-cash adjustments or whatever, and I understand that you're a growth story, and I understand you can be patient on the bottom line with the growth story, with the growth's coming. There are others that we don't have to name that are getting all kinds of crazy valuations, and they're not making money. So I'm not picking on you, but I need to understand that. And if you're not cash flow positive yet, how close are you to that?
Yeah. So last quarter, if you take out some of the timing adjustments and when you actually receive royalty revenue, we were essentially slightly cash flow positive. The net income was derived from those graphite royalties you mentioned, and part of us tightening up our model around that focus on precious was we sold the 2 graphite royalties that we acquired at really good value.
Right. I remember that press release.
To electric royalties. And look, we think those assets have a chance to re-rate and achieve full value in their portfolio, where, again, we're precious focused. It wasn't going to be an asset that we look to hold long term. We saw good value. We realized that value, or at least some of that value, at a multiple of what we paid for those royalties. So, and I think it's a much better home for those to be in electric, and I think we'll see a win at the end of the day on top of what we've already realized on that asset sale. So that's what drove a lot of that net income growth. We've essentially hit cash flow positive next year. That there's a lot of incremental dollars falling to the bottom line. So we're right at that inflection point, which I think is really productive for our business and for our shareholders.
Okay, so you have a one-off, positive hit to the bottom line. I get that. Can you say, do you have guidance? Do you expect to remain cash flow positive for Q3, Q4 this year?
It's going to be really close.
I get the growth next year, but for this year,
Yeah, it really comes down. It's kind of semantics. If it doesn't come in, I think we'll hit the guidance that we're out there with, which was we doubled our revenue guidance from around 2 million CAD to between 4 and 5 million CAD. That was about a month and a half ago that we doubled that guidance. It depends on the timing. Obviously, Speculator just hitting commercial production, some of the timing there. So it'll be close. It'll be really close. Next year, we're obviously projecting for that to be, very significantly incrementally positive, cash flow positive. And we have a number of new royalties that will be kicking into cash flow as well and revenue for us. So next year is really when we hit that major inflection point where a lot of that cash that's generated at the top line is falling to the bottom line.
All right. And meanwhile, in your own C-suite, the focus is still very much on more acquisitions and growth. And has anything changed? You've matured. Well, you've got 55 royalties. You don't need to run out there and have a portfolio. Does anything change going forward in terms of your acquisitions, or what are the deliverables that you're telling prospective shareholders now for the year ahead?
Yeah, we're always looking for value. I think that's probably something that you've seen in the royalty space is there's a lot of big valuations and a lot of very expensive asset acquisitions that, in some cases, royalty companies are buying assets that they're expected to actually lose money on if they don't see incremental positive news or positive results in the gold price or in new discoveries. That's not our business. Our business is around finding really good value on assets. Our focus is assets that are anywhere from, call it a quarter out to 2 to 3 years out from production. That being said, if we find something that's just unbelievable value, where we can really see daylight on that value incrementally increasing for our shareholders within the portfolio, we will take on some of those opportunities. But you'll continue to see us be very disciplined in terms of what we acquire. It'll always be for very good value. We will articulate that in detail to the market and to investors. And so that will continue. But we're really excited. I feel very strongly that our existing portfolio is one of the most undervalued out there in the publicly traded royalty space. And there's not another company that's come online. You noted when we went public, we had 1 production stage asset. We didn't say we had 5. We said 5 was coming. Well, 5 is now hit. We're telling the market that we will have 10 by the end of 2023, and potential upside to that as well. And that doesn't count any new acquisitions that we make. So we project out what we believe is to have 17 plus producing assets or more. That's a tremendous percentage of our overall portfolio that we expect to be in production over the medium term. And there hasn't been another royalty company that's been able to organically do that. Remember, we've done that in one-off transactions. This was not an acquisition of Newmont's monster portfolio or another monster portfolio. And that's a lot of the reason why we've got it at such great value for our shareholders is because we've been doing this with our proprietary methods of sourcing deal flow. We do it outside the scope of competition, and we've been able to build a portfolio at great value for our shareholders that I believe is re-rating for them. And that's driving some of that fundamental increase in the stock price as well.
I hear you. And I noticed the typical price of the acquisitions was manageable for a junior royalty company. But suppose you found something, where you thought just unbelievably undervalued. I can't believe this is on the market, but they want $50 million for it. Do you have the relationships? Do you have the iBankers lined up and the people there that if you needed to, you had a great slam dunk deal, could you pull that kind of financing together?
We do, but it's got to be a really special transaction, and it's got to be financed in the right way. I've been very consistent in what I've told the market. We have no desire and no need to go raise equity capital anytime soon. We have raised $30 million over the last approximately 15 months. That's all been done at $3. So again, we're relatively flat from where we raise capital. We will continue to make very strategic acquisitions that don't overly dilute our shareholders, and done in a fashion that limits that dilution. So if there's the right transaction, we absolutely have the financing capability to go take it down, but it's got to be something that tremendously increases the value for our shareholders, and we're very disciplined on that. So we've seen a host of transactions in the, let's call it $30 to $100 million range, where we can take advantage of those if we want, but it's got to be the right deal at the right price point. That really creates that value for shareholders. So I think we've been very disciplined in terms of what we've acquired.
Well, I'm happy to hear you talk about the discipline. And I did note the share structure. It was interesting. And when I was looking at the other thing that really caught my eye was the percentage of insiders and management, the percentage of the shares held. And I like skin of the game. So you've been a good sport with some pretty rude questions here. I always close these interviews off with the skin of the game question. So I got to ask you, Kyle, if you want me and my readers to put our money into your stock, how much of your own money have you put in? And I mean cash, not just free options you got.
No, 100%. And I definitely worked for a lot of the equity that I have at a hugely discounted price for many years while we were private, which is certainly part of it. And I think that should be rewarded. But I have over six figures into it. Management put approximately 450, almost $500,000 into our IPO that was back in May. So we have meaningful skin in the game, and I can tell you a meaningful amount of what was liquid net worth has been invested in terms of hard cash back into the company. So, we eat our own cooking here at Vox. We're happy to do so, I'll tell you that. And we built a company to be aligned with our shareholders. Our original shareholders that gave us $7.5 million back in 2013, 2014. They still hold every share. They were intimately involved in terms of how we deployed capital and where that capital went, and looking at it from a shareholder perspective. But me as a very large shareholder, we're very, very aligned with achieving long-term shareholder gains, and that is the focus for our business. We're not kingdom builders. We're not here, to enrich ourselves at the cost of shareholders, which unfortunately this space certainly has seen its fair share of. So I think your viewers and your relationships can have confidence and faith in us working very hard on their behalf.
All right. Well, that was a good answer. And again, you sat still for some pretty tough questions, which I greatly appreciate. So I'll let you have the last word. Is there anything else you'd like to tell the audience out there?
Yeah, I appreciate the time. It's been a pleasure, and I appreciate the direct questions. Look, for the viewers, I believe our company is significantly undervalued. We have what I think is truly one of the most exciting royalty portfolios that, without us doing another deal, is going to re-rate for the benefit of our shareholders. We're dramatically undervalued versus most of our peers, and I don't think there's good basis for that. And so the things that were holding us back, I think we've done a reasonable job at over the last few months in terms of correcting. And I believe the fundamentals of our business will start being reflected in our share price. So appreciate the time to tell a little bit about the Vox story. Obviously, VOX.royalty.com for any further questions. Always happy to be in touch. IR at Vox Royalty Corp at VOX.royalty.com. I answer most of those emails. So if anyone has any further questions, always feel free to reach out to me. And I think Lobo could also probably put us in touch.
Okay. Well, thank you, Kyle. Good luck with it, and keep us posted on your progress.
Will do.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.